Hi, Barbara Friedberg here, former portfolio manager and university investments instructor. I'm here to teach you how to be a smarter investor and make successful investing decisions. Today, we're going to be talking about what is a good investment return and how do you measure your investment portfolio return. We're going to talk about figuring out how well your investments are performing, whether 10% is a good or a bad return, and then how to measure both your return and compare it with the appropriate benchmark returns. So let's get started. Someone came to me recently and she was very distraught. She said, I just looked at my robo-advisor investment account and looks like I only got 6 or 7% return this year. What's wrong? That robo-advisor is terrible. And so we looked at the investments within her account and found out that 50% of her investments were in US and international stocks. And then another 50% were in US and international bonds and some cash. And so what we discussed was, although the stock market performed very, very well last year, hitting close to 17% return, the bonds and the fixed income market did not do as well. They returned, probably, under 5%, maybe 4%, maybe even less. So when you combine the two portions of her portfolio, the 50% in stocks and the 50% in bonds, a 7% return is about what you'd expect. And there's nothing wrong with that return. It is appropriate and it is very good for the investments which she owned. So let's get going and figure out, what is a rate of return? You know that when you invest $1,000 in the bank and you get a 1% return, you will receive $10 at the end of the year. If you invest $1,000 in the stock market and you get a 10% return, then at the end of the year, you will have a $100 return. Here's how you figure it out. It is so easy, and ROI simply stands for return on investment. To calculate this, you write down the amount that your investment value is worth at the end of the year. So if you invested $1,000 at the beginning of the year and you earned a 10% return, you'll have $1,100 at the end of the year. So you put that $1,100 and then you subtract the original value of the investment, which was $1,000, and you take the difference between these two numbers, which as we know is 100, and you divide that by 1,000, your original value of your investment, multiply that by 100 to give you a 10% annual return. Very, very easy to figure out. If you don't want to do it yourself, there are plenty of online calculators that can help you with this. So now you know your portfolio earned 10%. But what you don't know is that a good rate of return or not? So let's figure that out. You start out by looking at your investment portfolio as a whole. And we'll use this example of a 25% invested in US stocks, 25% invested in international, 25% in corporate bonds, and 25% in government bonds. And for our example, we are assuming that the investor has used index funds, which are groups of investments that are designed to mirror the actual indexes of the US stock market, international stock market, corporate bond market and government bond market. So here's how you can compare and figure out whether your return was good or not. In this example, and let me stress this is an example, this isn't real data. After a year, if your portfolio returned 10% for your stock investments, 6% for your international stocks, 3% for the corporate bonds, 1% for the government bonds, then your total, if you add up 25% times 10% with add 25% plus 25% times 6%, 25% times 3%, 25% times 1%, you will come up with a total portfolio return of 5%. That's your 1-year annual return for this investment portfolio. And if you have a brokerage account, which of course you do because that's where you keep your investments, they will tell you what your investment return is. So it's very easy to calculate. You don't even have to do it by yourself. Now you want to figure out, is that a good return or a bad return? So you go to your benchmarks, and here's where benchmarks are unmanaged indexes, and they're apportioned out by the type of groups of investments. For example, this benchmark for US stocks is a total stock market index fund, which is designed to represent the total US stock market. And my return of my portfolio for US stocks was 10%. The benchmark returned 11.5%. So I kind of underperformed in that category. Then we'll compare my 6% international stock return with my benchmark fund, which was a all-world ex-US investor shares Vanguard fund, 6%. Corporate bonds, this was my return, and this was the return of an index fund, the Vanguard Intermediate Corporate Bond Fund. Government bonds, I returned 1%. This fund returned, the Vanguard Intermediate Government Bond Fund returned 1.5%. So my portfolio return was 5%. This benchmark portfolio return was 5.5%. So I did rather close to the benchmark. 5% versus 5.5% is respectable. That's fine. That's a decent return. Now, where do you get the benchmark information? I borrowed it from some investment funds. You can also get it from places like Vanguard's market data, where, for example, you can look at the Standard & Poor's and see that for 1 year, the Standard & Poor's returned 17.5%, and this would be an unmanaged index, not a fund, of the 500 most important companies. And you could also use this percentage as a benchmark for your US stock investments. So simply put, how do you calculate that? Well, it is very, 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 very easy. Here is the formula. You just take your return and you multiply it by the percent return and the percent in your portfolio, as we said before. So 10% return multiplied by 25% in US stocks, and you add that up going down the list. And that gives you your investment portfolio return. So to wrap it up, You can determine whether your investment return is good or bad by comparing the percentages that you have invested in various market sectors with the overall benchmark for that market. And I'll tell you a little secret. Investment research has found that over the long term, matching the market returns has been the best way to maximize your investment returns. In fact, over the long term, nearly only about 30% of managed or actively managed funds tended to beat the market returns, whereas 60 to 70% of the time, the market returns beat those funds that were trying to beat the market. So you will do just fine investing in a diversified index fund portfolio. If you have any questions, please leave them in the comments section. Subscribe to my channel if you think this was helpful. Give me a thumbs up. And I look forward to seeing you next time. Bye.